Hello, welcome to another episode of Leaders in Lending. I'm your host this week, Matt Snow, joined again by Armen Meyer. Armen, good to see you again. Welcome back.
Thanks for having me back. I'm honored to be back 3 days after an election that was wide open. So I hope there are many curveballs in this conversation. I'm looking forward to it.
I know it's funny. It is Friday, so the election just a few days ago. The last time we spoke was around the CFPB and the challenge to their existence and funding, and a lot's changed even since then. We've been keeping in touch, thinking about open banking, which we'll get into. But with the election, as it tends to do, it changes the perspective on a lot of things. So I think we got a lot of ground to cover. But maybe why don't you start? We didn't really do a proper introduction to the audience last time. Why don't you give a little bit of your background? I think it will help people understand the depth that you bring to a technical and robust conversation like the one we're about to have.
Oh, that's nice of you. Well, I guess I'm known for my role at Lending Club for about 6-7 years and started the American Fintech Council to our current audience. But before that, I had a role at PwC where I was kind of the guy who was supposed to analyze these election outcomes for our large bank clients and kind of put in perspective like what could happen. In fact, I actually just read the one we did back in 2016 when Trump won the first time. Good news, not much relevant today except for a couple points. So not much regurgitation. But I think some of that might be helpful as conversation, some of the views of what we saw regulators and supervisors do back then. Before that, I was chief of staff of New York's bank regulator, helped us transition to become the Department of Financial Services, left soon thereafter, and got a front seat to the financial crisis during that period. I was kind of doing work for the governor of New York when the crisis hit and started doing a lot more work in financial services to see what we could do as a state to make regulation work right in the future. And before that, did have several roles advising congressmen and governors and candidates for office on broader political strategy and policy for a few years after law school. I was a lawyer for 1 year of my life, and clearly that was not my calling, but every now and then it's fun to grab that and use it in conversations like this.
1 year. Okay. I've got a 18-year-old looking at colleges now with an eye towards law school. We'll see, he's in it. Internship right now, and we'll see if he makes it longer than a year. Where he ends up going.
Happy to talk to him, warn him, or encourage him, depending on. Everyone has a wrong motivation, I think, in the beginning. You don't really know what you're getting into until you get into it. I should mention that lately, for a year now, I left Lending Club about a year ago, and I've just been advising a lot of companies in Gen AI, in fintech, and me and some folks. A couple of venture capitalists started a fund a few months ago investing in AI foundational models and impact in financial services and fintech space. So it's been a pretty fun year, and have my own consulting firm now focusing on financial health outcomes. I have a few clients who are really interested in kind of bulletproofing products, and that's been a really enjoyable thing to be able to do as well. And very relevant to changing regulations, I think, how you approach those clients and conversations.
Yeah, absolutely. And AI certainly in the news a lot lately and a fun topic to dig into. But I've been surprised, open banking, maybe not quite as much, but it seems to be trending and getting a lot more airtime lately, as much as AI, especially in financial services, which made me go back and do a little bit of like history researching and reminiscing, because I was also actually at a bank during the great financial crisis, and a little bit of like PTSD going back through and reliving some of those as I was thinking about open banking and, the Dodd-Frank Act, and really the genesis of a lot of these, 10, 15 years ago. And thinking about that, hundreds of pages of regulation, like why do you think it took so long to even today, November of 2024, 15 years later, to get to any kind of a conclusion, or I hate to say resolution now that we've had an election and things are likely to change again, but what took so long for that piece of the bill to actually come to some kind of a conclusion?
And if you can believe it, there were a couple others this year that got finalized, or this past couple of years, that also took a long time. Well, first of all, Dodd-Frank was huge. There were a gazillion regulations. And from my time at PwC to my time at Lending Club, we were wondering, why is it taking so long? And like one reason, of course, is the obvious. You change administrations, things change, things get dropped. That really did delay a lot of Dodd-Frank implementation. You also had quite a anti-regulatory bend. In fact, you had under for example, the CFPB, which we'll probably get into as we talk about 1033 and open banking, take back some regulations as opposed to promulgating regulations. So you definitely had not just changing, you had an anti-regulatory environment, but first and foremost is open banking was not the issue of the day coming out of the crisis. Coming out of the crisis, something we talked about last time, the mortgage market had blown up. How do we fix that? What's the new way to create an infrastructure so we don't have that again? Other types of regulation. What's a way of creating less asymmetry of information between bank and customer so that the customer knows what they're doing? And then other type of regulation, how do we just simply ban conduct we don't like? Those regulations got a front seat. Open banking, I would put in the infrastructure, but it wasn't about the mortgage, right? This is like a latest infrastructure regulation. Great to have, was not a priority, but glad we finally got there.
Yeah, I'm glad you said that because I, again, like was doing a lot of research and I was having a hard time finding like how that even made it into a part of Dodd-Frank. Or you think about, again, the transparency or separation of banking activities, capital requirements, all those things that were tied much more to the issue of the day, credit quality and being much more focused on those disciplines. What do you think led it to being a part of that? Like what were they trying to solve? It doesn't seem like there was a lack of competition that led to these issues in the banking industry, or like consumers didn't have that much of a lack of choice. Is that something that's become more of an issue today that is finally becoming a priority, or was that an issue then and just maybe wasn't as high of a need to think about?
You're straining my memory, but I do think a lot of actually Director Chopra's rhetoric is reminding me that I think some of the initial ideas in 1033, and I believe it's 1034, I know it's 1034, Section B perhaps, is really about the consumer. So it's a consumer protection regulation in my three buckets, as well as an infrastructure regulation. But the consumer aspect probably drove it, in that the consumer shouldn't have to pay to know about him or herself. And 1034B has been implemented by a CFPB, not as a formal rule, and 1033 kind of follows that. But I think in time, as tech emerged, 1033 became a more important thing as we saw fintech evolving and the use of APIs. So it did, and I'm almost feeding into the lawsuit against it, which we'll get to later. I think the priority did change a little bit over time, but I do think both are in scope and both are very important.
Yeah. Have you seen any companies like try to fill this space ahead of the regulation? Like, aren't some of the bigger banks doing this already? Or you talk about API enablement, like aren't companies coming in to fill this gap and give the consumer some of that transparency? Like, do we need this kind of a regulation?
I love the do we need it question, because it is really interesting, because other markets did have the private sector lead the way. But we found in the US is first you had, of course, the screen scraping debate. Is that the safest way or smartest way of doing this? And of course, screen scraping does have not just data issues, which is for this conversation probably the most important thing, where it's not always accurate, you can't always get it right. But two, you have, of course, the idea you've now given your credentials to a third party that's going to sit there, and more issues of fraud and intrusion in someone's data. But second, even on the API front, even when you're not doing screen scraping, APIs are not always reliable. You have to invest in an API. And part of the reason we're here today is this API technology and the ability to protect your API is way better than it probably was way back then. And then two, even with APIs that are robust, and a lot of times APIs are weird rules, like is the data conversation the same on both sides? Is the API always available? Is it always functioning because it's well run? These are all the technical issues that got in the way of even a non-screen scraping world, where Plaid and others went from screen scraping to actually going API based, and it still wasn't solving the problem if we actually want real good data on demand with complete accuracy. So the final one is everyone in the pool. Like, you can have the APIs, you can have the screen scraping, but then who's playing? And then a lot of banks are now being encouraged to jump into this pool of sharing data. Not as many as originally intended. Some have been carved out, the smaller ones. But I think those are some of the three issues that this rule tried to address.
Gotcha. You said a word that's jumped out to me and maybe to some of our other listeners who are on the industry side, working at banks and credit unions, invest. Like, do you think this, if wouldn't they have already done this today? Like if it was cheap or easy or accessible, like is this going to require a lot of smaller, mid-sized banks to spend money that, maybe they don't have prioritized, or how do they even think about like an investment in this space to be able to accommodate this?
Well, we started out talking about generative AI for 1 second, and we talked about it last time. The data is more important than you got to have data before you can analyze something, see every foundational model. And I don't want to dismiss concerns on getting your API up to snuff or making this work or liability if things don't work. But the future is data, and the data can't just sit in 6 big banks. Because if it does, we're all kind of screwed. And that's the end of innovation. So there is a price to pay for innovation and a competitive marketplace. This is the price. But I will say, give the CFPB credit. The implementation timeline is long. It goes all the way to 2030. The smallest banks, 850 million in assets and under, are not included. I don't think a bank below 10 billion has to do anything for at least a couple of years. And to where we started, the tech is better. And it's not like there's a random API provider. It's like this is a core provided thing now. I'm not saying this is easy or perfect. I'm just saying that like tech has moved us forward in a way, and the need, and we've seen the benefit of sharing data on full display, and to squelch that was the wrong move, and to empower it is the right move. And there is a cost, but I'm glad to see that some banks have the option to stay out of it. I think some people would be paternalistic and say, oh, everyone should be in it because it's good for the consumer. Well, the consumers can move that. And consumer moving is not easy, but we don't have to treat all banks the same.
Yeah, that's a good point. And I've been trying to think of other like similar instances of this in the past, like maybe CECL requirements. Or can you think about other things where like there have been time to move through and kind of catch up? Or
I think a lot of the implementation regimes have been focused on bank size. I mean, even the other regulation that I mentioned, there's other regulations that just came out, Section 1071. What's 1071? It's small business lending transparency rulemaking. That also took a long time, probably because small business lending is really not a core CFPB competency. And it also was not irrelevant to the crisis, but few were saying it was foundational or highly exacerbating of the crisis. So that also got deprioritized. And you do see major time lags in implementation there. And I think that's the right approach. All banks are not created equal. And if the irony is that the goal of open banking and 1071 is to share data so that people get a better sense of who's providing the best product or can easily go to the best product, it would be funny indeed to have those same rules impose enormous costs on smaller players and wipe them out when we're trying to promote competition here. So we should have implementation timelines to help them out a little bit.
Yeah, well, I was thinking about that too. Like, what do you think? Do you have any predictions on what may happen as a result of this? Like, do you think there will be more M&A activity? Like, will there be some that just can't or don't want to compete in the space, and the bigger players will gobble them up, or in the middle of the market, more consolidation? Other tech companies to fill this need, or like, what do you see as maybe a reaction?
I think the open banking driver on M&A is not significant in the near term compared to other factors. And the number one factor, which I'm sure we'll get to, is the change that's going to occur at the FDIC and the OCC, and then more broadly at the FTC for M&A activity. And others are declining interest rates, and more of a sense that the recession is not coming, if that's true. That's the way it looks. So I think these factors are going to be much more a driver. The other thing on open banking, just so you have it, that's come up is, will open banking drive M&A, or will it in fact make the financial system less stable, because open banking, of course, does two things. One is, hey, I'm a customer. I'm at pick your biggest bank. My old employer lending club or your employer Upstart wants to make a loan to the customer, but needs that data at JPM or whatever to help make that loan because it'll help reduce the cost of credit. That's like the classic example. And the customer should be allowed to give that data to do that. But the other one that has come up in terms of could it create bank runs is Lending Club Bank, I think, has a great APY compared to a JPM. And so why don't people now take their data, which is no longer trapped at JPM, and bring it to another bank to get a better APY, maybe a better experience overall as a depositor, maybe better products. Some have said similarly, like, won't that really change the world? And I'm kind of like, not really, not really. There's so many ways in which there are tendrils in bank deposits that is too hard to move. You got to reset up your Venmo payments. Open banking solves some of those, but not enough. And we're not going to see massive runs because of your ability to move data. I think APYs drive it more and marketing than does your ability to move data.
Yeah, I think that's right. And maybe not to zoom out too far, but then what do you think consumers are looking for from a bank today? Is it a one-stop shop? Is it someone maybe like I can trust with a core relationship, and then open banking allows me to pick and choose more point solutions? Like you said, for lending, I'm going to go to Upstart or Lending Club. For an auto loan or for a brokerage account, I'll go somewhere else. What does it mean, like in the financial services? Who's going to win this space, or a consumer?
Well, I think you're now getting at my biggest criticism of the rule, because the winner is the one that can actually hold on to the data the longest and provide those services. And the rule, in some respects, moves us backward. It's in terms of competition. So the rule does the right thing. The rule does is what we discussed. You can now use the API, and you can go to that Lending Club for your point solution or your Upstart for your point solution if you don't like your bank solution. I think the idea that one bank is integrated everything is far off. We haven't seen the big banks really innovate enough that future is near term. What we have seen is Upstart, Lending Club, and others come in, lower the cost of credit, and seeing the big banks follow by creating their own personal loans and not even doing as well. See Goldman Sachs failing to be a personal loan player. We've also seen APYs go up because of fintech. We've also seen overdraft fees go down because of fintech. So I don't see a world where you can empower just a few banks. What I worry, though, is that this rule, although in some ways makes it better, to not rely on a few banks, it also makes it worse. How does it make it worse? Two ways. One, when a customer gives their data to an Upstart or a Lending Club to provide a better loan, Upstart or Lending Club want to hold on to that initial data because their model depends on knowing where the customer started and what data had in order to continue to improve that model over time, so that that same great product can be offered to someone else in the future. Initially, the rule said, sorry, Upstart, sorry, Lending Club, you can't. You can't hold on to it. You can use it once, but it's a secondary use that's banned to hold on to it for product improvement. Luckily, the CFPB came to a consensus. So that part was obviated in its final rulemaking. What was not obviated, which I think will be a competitive advantage for the fintechs that have done so much, is one, what about holding that data to create new products? And by the way, clearly there's a privacy concern. I get it, you get it. But there is this thing called de-identification, which is the CFPB itself advocated for in its 1071 rulemaking. It said, banks, don't worry. No one's going to know unless we tell them who it is because it's de-identified. But for some unknown reason in 1033, that's not good enough. We're too worried about Lending Club or Upstart and having that data, even if it's de-identified, for the purpose of new products, new research. Now, Road Chopra did say researchers for nonprofit in the future can do that. But I don't think that's not going nearly far enough. And I worry about a world where only JPM can use its data for that purpose. So I hope we can think of some ways of fixing that down the road. The second one that's a little concerning is cross-sell. I know cross-sell is a bad word, but let's be honest. The fintech environment selling into consumers has made financial services a lot better. Sure, there's some bad actors. We have a trade association called AFC we talked about before to help separate good from bad. We'll keep doing that work. But if we're so worried that Upstart or Lending Club are going to use that data to see, hey, actually, you JPM customer, you are getting screwed on your annual percent yield, or you're getting screwed on your auto loan. I know you came to us for a personal loan, but we can do more for you. And we're so worried about that. Then we're just in the world where we're just going to shoot spam inboxes to try to get customers. And the idea of tailoring products to a customer is out. And we're still in the world of tailoring a product to what we want to sell, which should be out. And unfortunately, I feel like this rule is going to make it harder to do adequate customer analysis to get them the best products that they need.
Oh, that's interesting. There could be a couple things that help that, though, right? That we talked about maybe offline, and one of them a little faster than the other. One being like the idea of a standard setter. So Plaid being the first, I think, in the gate to do that. So we talked about like the American Fintech Council, or the idea of a group or a company coming in to set a standard, like let's come together as an industry and try to solve this problem versus, regulators and policymakers who they're good at getting elected and raising funds and sometimes legislating, but not always, as in the weeds and the details of our industry as we are. So, let's try to come up with the answers as a team.
And an answer there, Matt, honestly, I think AFC is well positioned, and others would be helpful as well, is to ask the CFP. There are goods and bads about change administration, and take depending on perspective. A good, from my perspective, on this rule is this rule may not be a closed deal. We can go in there and say, hey, if we're so worried about secondary use of data because you're worried about the spamming using that data, you're worrying about learning enough about the customer, you can actually raise prices. We have TILA that defines pricing. We have APY defined. Why don't you just say, unless it's a lower price product, you can't offer it. If it is lower price, you can. And there are compromises here to make the secondary use of data so powerful if we need to compromise. So I do hope we'll get a second day in court on that issue, because I don't want JPM and Wells and a few banks being the only ones who can do that, because either they won't, or if they do it, they won't do it as well as having a competitive market. So to come back to your question, God, I hope we don't end up in one-stop shops. I don't believe in government controlling everything. I don't believe in two corporations controlling everything.
Yeah, I agree with you on that. And you hit on the other thing I was going to mention is we'll probably see this grind through the court system for some time too, right? Because I think there was a note in there, an exception to kind of protect IP or things otherwise protected under law. So, I imagine we'll see some companies trying to protect data that, like you said, they're using for underwriting other products that they feel is pretty proprietary or critical to their business, that maybe slows down some of the use of this as well.
That's right. We'd be remiss if we don't mention the case that was filed the day of, where net, the big banks have decided this is not good for them, even though I've made arguments that it entrenches their monopolies. I understand that position, that it's ultimately better for fintechs. This rule is better for competition than no rule, for sure. And they are making arguments that we've heard before in other contexts about everything you just said: ad fraud, ad cybersecurity, ad we don't trust those fintechs. And so we'll see how it plays out. There's no way to know, in my opinion, absent being some great litigation analysts, because we've seen what the courts can do. And they know how to pick their forums. They're not dumb. So we'll see what happens. But what I do think, Trump is president, will be president. The CFP director will change, maybe not day one, but close to it. The world is different. Why do I say close to day one? Because there's a Supreme Court case in 2020 that ends the idea that the director is a 5-year term, and it's now serves the will of the president. As we discussed in the last podcast, that's a bad thing for the world, in my opinion. I do like the idea of agencies having to be a little more measured and keeping old guards in for longer. I think that serves our stability better, but it is what it is. So we'll see a shift there quite quickly, and there will be an opportunity to change the rule as needed. I don't know if we taken if the litigation does not succeed. CFP will make a choice. Do we defend this litigation or not? That will be a choice. They can choose not to. I don't think this rule is like one of these rules that when we go through the future CFPB in a few minutes, this is not the rule that the CFPB is like going to blow up under Trump. This is not priority number one, in my opinion.
Yeah, I agree. And maybe that's a good segue. Like, of the other agencies, where do you want to go next? Now, like you said, we're starting to get news of Trump and his transition team and cabinet, and see who he's going to start selecting in some of these roles. Like, what are some of the things you're looking for, or thinking about the changes that could come?
Yeah. Let's do the other agencies broadly, and then it might be worth coming back to CFPB on like CFPB, what they're going to be thinking the next few months and what the Republicans will be thinking when they come in. But more broadly on regulation that impacts all of us, I think we're going to see quick transition at the CFPB and the OCC. The OCC, again, normally a 5-year term. In this case, not, because Comptroller Sue was never confirmed. It was enacted. So those would be the two easiest switches for Trump. On the other end is the Fed, where nothing's changing for years, couple of years, because the Fed is very structured, board by board member, long terms. One nuance that could be interesting there is what happens to Mike Barr, the Democratic vice chair for supervision. Now, Trump had in his vice chair for supervision, Randy Quarles, and he resigned in his due time for policy or whatever personal reasons. He was not forced out. He was around for about a year. I'm sure there was some behind the scenes stuff, but there wasn't this big kerfuffle. In terms of rules and those other agencies, I think we'll get back to CFPB in a second, but I think the bank partner model is the one we all care about the most. So obviously when you change these regimes, you're looking at three things broadly: rulemaking, enforcement, and supervision. At the FDIC and the OCC, if you talk to the bank partners, you may know this. I'm sure all the vast banks know this. The supervisors have been quite challenging. Some of the rulemakings that are pending have been quite challenging. So slowly things will calm down, but it's not an overnight thing because we're talking about the supervisors. These don't happen overnight. So I think FDIC, OCC relief, Marty go, Sue go. When you get to supervised level, change is much more slow. When you get to enforcement and rulemaking, change is much more quick, right? Because these are things that are more top of the house, less about implementation. So I have the sun coming out here. So we're going to see a lot of action in the rulemaking side. So at the FDIC, there's this rulemaking on how we deal with BaaS banks and reconciling of data, especially when it's a BaaS. I guess we're calling them API conduit rather than intermediaries these days. With those, that's an issue that could go away. Broker deposits impacts the bank BaaS model. I won't go into details. That could go away. Probably will go away. I would bet. But CFPB, we have a lot of interesting rules, honestly, that are in play. That I think if you look one by one at the rules of CFPB that are pending, you'll notice, wow, except for open banking, no major rule that the industry really had a strong opinion on was finalized in the past 5 to 6 months. Why is that? Because there's a thing called the Congressional Review Act. And Congress, now that it's flipped, most likely in the House as well, we don't know for sure, can do what it did in 2017 and before that, and 2020, really 2017 and 2021, and just strike down these rules at a pretty easy vote, no Senate filibuster. And when you strike it down, it's gone forever. You can't, under the rules, if it's reasonably related, do another issuance on that topic. So there's a reason why there haven't been a lot of rule finalizations lately. And I'm happy to go in like what the three big ones are, but I've been talking for a long time.
Be interesting because I would like to know where you think those are. I mean, if the markets are any indication, people are expecting that to happen pretty quickly. We saw the morning after the election, uh, big banks, technology, fintech companies seem to get a bit of a boost from that perception that a Republican-controlled administration from top to bottom is going to lead to a lot of more flexibility or openness for those companies in those sectors to operate, I think, a little more freely.
Yeah, I mean, I think starting with the rules and the one that most drove some of the market change, we'll get to the pending ones in a second, but a finalized one was the credit card late fee rule. Basically saying you used to be able to charge $32 under TILA for for lateness on repaying a credit card. Now you can only charge 8. You saw those stocks go up pretty big of those companies because that rule has been mired in the courts. And now the CFPB can choose not to defend it or to later repeal it. Repealing is hard. And that rule was final before the CRA window. So that's not something Congress is going to be able to Congressional Review Act. So my gut is that goes the way of the courts. The courts strike that down. CFPB doesn't defend. In the next bucket are the ones where the CFPB had to have had some intentionality of not finalizing. The big 3 there, which have been proposed over the past year, is number 1. I mean, the CFPB has made no bones about it. They're interested in big tech. So what did they do? They had that rule that allows them to supervise big tech companies in the payment space. They use their payments hook, this thing called a large participant rule, and then they can supervise the big tech companies. And that was not finalized. That's going to be the most intriguing one to see what they choose to do. If they choose to finalize it, then it can get CRA'd, and they lose that as the statute is written for a long time, but not forever. There are many ways around it. We don't know. That's uncharted territory for the most part. So what are they going to do? They're probably thinking, are there enough R's who won't CRA this? Is big tech still not popular on both sides that we can get away without and finalize this thing? The others, I think, are easier calls for the CFPB. The other 2 are overdraft fees, proposed this year but never finalized. I don't think they're going to finalize it. I don't see R's defending that in CRA. A rule like that is like the credit card rule and draws the ire of the industry. So that one's going to get, I think, not finalized if I'm betting. And the other one is the EWA rule, which only came out a couple months ago. That was done as a proposed rule, although they could have done it as a final interpretive rule. I'll get to that in a second. And they chose to do it as a proposed one, probably to not make it CRA-able because they only got it out in July. I don't know for sure. Maybe overthinking it. But these are very smart people. So maybe they have a smarter reason I'm coming up with, frankly. But that's my thought. So the EWA one, they got to make a call. Are we finalizing it or not? Because in their view, California's rule isn't good enough to regulate the EWA market. They made that clear in public statements. They even wrote a comment to California telling them make it stronger. And the California didn't. So now they did their own. And they got to make a tough call here. So those are the 3 calls, I think. There are others. Those are the 3 main calls. I'm so sorry. Earned wage access is the course that industry and fintech that some love and some hate. If you love it, you view it as a way of getting your wage the second you earned it. And I think there's a lot of compelling reasons to view it that way. Like, why do we have an arbitrary 2-week, 1-month cycle before getting paid? Now, not every EWA is alike, just like not every personal lender is alike. So the rules may be needed for some EWA players. So this is that it looks more like payday, and that's the debate on both sides. But yeah, so that's a big one. Now BNPL, buy now, pay later. I'll stop after this 5th one. That one was finalized probably before the CRA window. On CRA, you can only go back a certain amount in time and grab it. You have 60 days legislative. Takes a long time to calculate that because what's a legislative day? You don't know it until you got it. Ditto going forward. Then you have a certain amount of time for Congress to go and repeal the thing. So I think BNPL is out of the window. And frankly, will BNPL get repealed or destroyed in court? Maybe, but I don't view it as a top priority.
Well, I know you mentioned which ones you might bet on. I'll have to go and check some of these new betting markets and see if they're out there, what the odds are. Like if you agree with the odds makers on some of these, if you can actually place bets on that happening.
That'd be fun if there was a rule by rule. I mean, it's a terrible thing. It's a terrible thing to joke about and to gamble on because it's really important, right? Going back to our earlier conversation. Last we spoke, I was saying we shouldn't blow up the CFPB and all of its rules because serious companies invest in the rules of the road and they want to be around a long time and they want what's best for their customers. And the major problem in life is for these companies, if rules can just go away, you can't invest and we can't grow our economy the right way. Moreover, fly-by-nighters come in. And there are ways to make profits in the short run, taking advantage of these gaps. And what is the incentive of being a good actor? And by the way, good doesn't mean I'm a great guy. Good means I want to last and be a good business for a long time and really grow this economy and provide a real service. So it's selfish too. But we want to empower that's the selfishness capitalism wants to empower, not the short term, not the taking advantage of regulatory gaps, whether it's a bad protection or an asymmetry of information where the customer doesn't know what's going on. So I don't want a lot of these rules going down. And I do worry that we're going to have a replay a bit of the CFPB blow-up conversation we had, where we know the CFPB is now constitutional on appropriations grounds. But now, given all the litigation, all the paths to litigate in the Fifth Circuit and in other circuits, you can see all these rules getting attacked by the actors that have the most to benefit from not having rules. And I don't want to see that race to the bottom. And I can just hope that the CFPB will defend its own rules because a lot of these rules are good for capitalism. And we don't need the short-term sugar high for a few years of economy. We need good growth, which we can get without getting rid of these rules. I worry about that. Similar with enforcement. Enforcement too. Clear rules got to be enforced or else they're not rules. And supervision, you got to supervise these things. Now, the enforcement we'll see a lot less of, some of which will be good, actually, is where you're surprised, right? You're surprised by the standard is this thing called UDAP. And we don't like surprises. And I know this CFPB tried to do a better job using supervisory highlights, publishing things to their credit. There were still surprises. And I think that will be good for industry. Some of that is good for the world and some of it is not.
Yeah, agreed. And I think to your point, there will always be bad actors. It's good to have that minimum set so that we can all play by the same transparent, open, agreed upon set of rules. Because all these things, with or without rules, it adds cost to the end consumer, right? If you let bad actors play, like you said, people will exploit them, they will take advantage, they will get their profits and they will run away and they'll be on to the next thing they can exploit. Regulation, setting the rules and enforcing the rules is expensive. So we have to choose the least of the evils and try to figure out a way to create a system that allows, I think you said it well, both, the short-term growth and innovation, but also the sustainable businesses that are going to stick around as well. And how do we satisfy all of those? It's difficult.
And elections are a decision on how you bias that line, because there is no perfect answer. I'm sitting here complaining open banking, but someone else with an equally valid point of view isn't. And it's going to be decided in a way by the election, because obviously we will now have more of a bend on these rules for more consumer take on the burden of for themselves. But also there will be some benefits to industry and growth for sure. But how you calibrate that is what the electoral process resolves. And so we're going to see a shift in that debate for quite a while. I hope, and I wish we had more 5-year structures. I think the FDIC does right. I hope Marty stays. You know what I mean? I hope that didn't like when McWilliams had to leave. I'm glad the Fed is going to be resolute. I hope Mike Barr, just like I hoped Randy Quarles would fill out his term. Those are good things because we need that extra stability in the system to avoid some whiplash. And I hope the CFPB and other agencies defend their long-established rules. and don't let some unsavory actors get their way on some of this stuff.
Totally agree. Well, Armen, I always feel like smarter coming into conversations with you because I always want to prepare and like think about things a little deeper. And then I end them like realizing I've got a lot more to learn. So I always enjoy our conversations in a way that, gives me even more to go now, research and think about and figure out the next thing that we can talk about. But is there anything else that you want to cover as we kind of wrap here and think about, the election and what's changing with all the rulemaking going on?
I just think next time, because what you said was so nice and way too generous, that I should ask you the questions, because I'm sure the level I'd be humbled would be more than you claim to be. So I look forward to the conversation.
That's the best part about being the host. I get to ask most of the questions, so that's the easier part.
No, glad to be back. I enjoy these conversations, and going back to open banking, I do hope there's an opportunity to make the rule better. I'm really glad and commend the CFPB for getting it done. It was a long time in coming, but I strongly believe it can be better for fintech, better for innovation, and we have to be anti-monopoly, and we have to be anti-big government. We have to be moderate on both these things, and I want to see some more moderation. And let's hope this election, and it may be a false hope, is not yet another stone in the extremism that we've seen in our society, which is not good for any of us. And I'm still hoping for a day where the moderates can be cool again, and we can only hope.
Absolutely. Well, appreciate you being able to join me on short notice and take advantage of all the activity going on and kind of capture this moment in time. And yeah, maybe we can come back and see our progression towards moderation and see if that's cool again sometime in the near future.
Great talking to you, Matt.
Thanks, Armen. Take care.